We're going to calculate the stock price of Anheuser-Busch, and the market cap is 92.4 billion. And the stock price is 46.88. So now we know how many shares outstanding. You just take the market cap divided by the stock price and you have 1.97 billion shares outstanding. And next we need to calculate the free cash flow. And the best way to calculate the stock price of a company is to estimate future free cash flow and discount that number back to today's dollars. And that's exactly what we're doing in this model. Next, we need the net income, which can be found on the income statement. And it looks like they have healthy numbers each year. Increasing net income, good sign. And last is revenue, which is also on the income statement. And that's pretty much steady over the years. Now we need to look at the capital structure of Anheuser-Busch and figure out the discount rate we need to apply to the future cash flows. So let's grab the interest expense. That's on the income statement. That's the interest they pay on their debt. And let's see how much debt they have. Go to liabilities section of the balance sheet. And current debt is $5 billion. And long-term debt is $96 billion. So they have a good amount of debt. 4.2% interest rate on the debt, which is okay. Interest payments are tax deductible, so let's find out their effective tax rate so we know what to reduce the interest payments by. So income before tax, 12.8 billion, and income tax, 2.8 billion. So 22% taxes. So that means the cost of the debt is 3.3%. And more than half of that capital structure is debt. So that's not the best sign. It's a little bit leveraged, but let's just see how it plays out. Now we need to find out the cost of equity, and we need the beta for that. The beta is 1.12. And the cost of equity is 11%, and the cost of debt is 3.3%. So equity has a higher return than debt because equity is lower on a company's capital structure. So in the event of a default, debt holders are paid before equity holders. So debt holders have less risk, therefore they have less reward. So 3.3% is their reward. And equity holders have more risk and more reward. Their reward is 11%. But when we blend these two numbers together, we get the WACC, the weighted average cost of capital. And this is the percentage Anheuser-Busch uses to identify whether a project is a good investment or not. So this is what we're going to discount the free cash flows by, to 6.93%. And we estimated 4 years of future free cash flow, and then we also did every year beyond 4 years, which is called the terminal value. We used a Gordon growth model for that. And then we discounted the numbers back to today's values, and we got $108 billion value of the company. And when you divide it by 2 billion shares, that's a stock price of almost $55, and it trades at 47. So according to the model, it's a buy. It's trading at a 14% discount. And you can see the stock price was trading well over 100 for a while. It's come back down closer to intrinsic. But it's interesting, the more I do of using this model, the better and more refined it gets, because I built into this a feature where it looks at the debt and it gives a haircut to the future free cash flows based on how much debt a company has. And I'm glad I added this feature because my numbers are getting closer to what they're trading at, which does indicate the model is working. And as you know, everyone has their own opinion on the value of a stock. Everybody looks at things in different ways, but this is my model and my opinion. So thanks for watching.